Well, let's talk now to Fiona Cincotta from City Index. Good to see you again, Fiona. Welcome back to the programme. Let's begin, if we may, then, with the UK interest rate decision. They stayed on hold, but there was a split decision, wasn't there, within the bank? What are they thinking, do you think?
Yes, it was interesting, the vote split. So the vote split was 6 policymakers voted to leave interest rates unchanged and 3 voted to cut by 25 basis points. Expectations were actually for a vote split of 7-2. So in fact, the vote split was just slightly more tilted towards a rate cut than perhaps what we were expecting, which really does open the door to the fact that we're now expecting, or the market at least is expecting, an 80% probability of a 25 basis point rate cut in the next meeting. The meeting comes as inflation in the UK is still above that 2% target level, 3.4%, although we have seen some signs of weakness in the underlying economy and in the labour market. So slowly and gradually, inflation is expected to continue cooling if, of course, we don't have disruption from high oil prices, which could be a potential possibility given the conflict in the Middle East.
So a similar sort of decision in the United States where the Fed held rates as well, despite the President's demands to lower them. What do you think happens next there?
Yeah, so it's interesting there because it's a slightly different situation. The Federal Reserve also lowered the growth forecast for the US and raised the inflation forecast, and that's to do with expectations surrounding Trump's trade tariffs. We've obviously got that universal tariff, which has already been implemented, the 10%. We've also got the unilateral tariffs that are coming potentially on July the 9th. We'll get some more information about what those might be, what's been agreed, what hasn't been agreed in the coming weeks. But the Federal Reserve Chair, Jerome Powell, did say that he expects inflation to rise meaningfully over the coming months and years because of these tariffs. So that's why we're seeing that more hawkish stance, should we say, or more cautious stance from the Federal Reserve regarding cutting rates further.
Let's talk about Switzerland, which seems to be on the point of moving back into negative interest rate territory. They have the rate now at 0%. What are the potential implications of that?
Yeah, so this is really interesting what's been happening here, because the Swiss franc is a safe haven currency. So what we've actually seen is the Swiss franc has increased in value by over 10% against the US dollar across this year so far because of these uncertainties that we've been seeing in the US. And that's sort of seen this rotation out of the US dollar into the Swiss franc. Now, a high-valued Swiss franc means that imports coming in are cheaper. It also adds deflationary implications to the economy, which is why they've had to cut rates again and potentially will be needing to cut rates again further in September. So that's going to be a really interesting one to watch as well.
Fiona, great to talk to you. Thank you for joining us. That's Fiona Cincotta from City Index.